I think a lot of investors need to be due diligence, before they just buy stocks that they may have purchased before. Think about things like, where is the production done? Is it coming in from Mexico or Canada or other countries that could lead to additional higher costs, which in turn is going to impact the bottom line for the companies?
If you think about Mexico for a second, 25% tariff, they're the largest silver producer. And more than 80% of the silver that the U.S. utilizes is actually imported.
And also going forward, I think we will continue to see some volatility, especially related to some potential supply chain issues.
On this episode of Early Bird, what will be the impact of the recent Trump tariffs on stocks and investing? What investments do we like with the tariffs, and what investments should be avoided? Joining us today on the podcast are Nick Bour, founder and CEO of Inspire Wealth, Alex Ebkarian, Chief Operating Officer and co-founder of Allegiance Gold, and Faron Daugs, founder and CEO of Harrison Wallace Financial. If you're an investor looking to stay on top of the latest market trends, then you're listening to the right podcast. This is Early Bird, and I'm your host, Stephen Lerner. Before we get to today's discussion, let me tell you how you can save time and beat the market through Early Bird, a free daily email newsletter featuring commentary about the latest trends in stocks, cryptocurrency, and equity crowdfunding. Early Bird is designed to help individual and non-professional investors stay on top of all of the critical investing trends. The newsletter is 100% free and is sent to your email box each weekday morning. Subscribe to Early Bird for free at www.earlybird.email. Once again, that's earlybird.email. And now, today's discussion. All right, everybody, welcome to the Early Bird podcast. Today, we are talking about the impact of the recent Trump tariffs and the threat of tariffs on the stock market in 2025. Tariffs were just introduced last week in the U.S., and there could be more tariffs to come later this year. What does this mean for stocks and different types of investments out there? What should investors know, and how should investors handle the situation? We have a wonderful roundtable of experts today. We're going to talk about these topics, but before we do that, I wanted to ask each of you, if you could, in one word, tell me the first word that comes to your mind when you think of the recent tariffs and the impact it had on markets and investments. Just one word. Faron, we'll start with you. What's the one word that comes to your mind when you think of what happened this past week with tariffs in the market?
Overreaction.
Overreaction, okay. Mm-hmm. Alex, tariffs in the market, the one word that comes to your mind?
Volatility.
Volatility, thank you. And Nick, last but not least, the one word that comes to your mind when you hear about tariffs and the impact in the market recently?
I would have said overreaction as well. I guess I'll say uncertainty.
Uncertainty. Okay. Well, that's a lot of investors feel that way right now. So, Nick, I'll start with you. You said overreaction, but you also said uncertainty. Tell me what does this mean for the Trump tariffs, and what does this mean for the market going forward in 2025?
I think a lot of investors need to be due diligence, before they just buy stocks that they may have purchased before. Think about things like, where is the production done? Is it coming in from Mexico or Canada or other countries that could lead to additional higher costs, which in turn is going to impact the bottom line for the companies? We've got to think about all of these things. And I think some of the other things that maybe a lot of us aren't thinking of right now is, can it benefit some of the companies that do a lot of their production domestic based, meaning U.S.? Are there companies that have good supply chain that can benefit from the tariffs? And it's a lot of question marks until some more things unfold over the next several months.
You're right. A lot of questions. I know investors generally don't like there to be more questions than answers, but that's where we are right now. Alex, love to hear from you. What do you make about what happened in the past week with the markets, the reaction? You mentioned volatility. There was, from the tariffs. What do you have to make of it all?
Well, in the world of physical metals, we've seen a couple of things. Since the outcome of the election, there were a couple of articles how gold has been moving outside of the London bullion market into the New York Market Exchange. And that kind of alluded that there was some shortages. In reality, they only moved about 400 tons, which represents roughly about 40 billion. And if you look at the total market cap of gold, that's about 0.2%. What I meant by the word volatility is we've seen a disruption on the supply chain. If you think about Mexico for a second, 25% tariff, they're the largest silver producer. And more than 80% of the silver that the US utilizes is actually imported. And obviously the tariffs, as Nick pointed out, is the country of origin. So in our world, what we've seen is that all of a sudden a lot of banks started rushing to get metals outside of that normal supply chain, UK and European Union, and that's how we've seen a little bit more volatility.
No, you're right. The price of gold, didn't it reach an all-time high just this past week in the wake of those tariffs as well? So
it has.
That did happen.
Did.
Looking sort of broader into the market, what it meant. Faron, you said overreaction. I assume you're talking about how the markets, especially the stock market, dipped in price on the Monday when we thought we were going to get tariffs. And then as some of the news sort of rolled back with tariffs, the market started to correct itself and get a little bit better. Is that what you're referring to? And do you think we might see more types of overreaction throughout the year as the threat of tariffs stays alive throughout the year?
Yes and yes. I think that the reaction was a little bit overdone, and part of that's just the sensationalizing of it. But I think, President Trump pretty well telegraphed the fact that he was going to use tariffs during his campaign. He said so before and after the election. And I really believe he's using them as a strong negotiation tool. As you know, he's all for shock value many times, and he throws this stuff out there, and it brings people to the table. And that's really what his main goal is to bring people to the table to really renegotiate these things. And the tariffs he was talking about with Canada and Mexico, they were more border control focused than they were price control focused or trade focused. He just used those as a way of getting them to the table to help, kind of with this border security in both countries. And it worked. It brought both of them immediately to the table, and I think rightly so. And I think if we look back to his first administration, because we do have a unique opportunity to look backwards and see how these things worked in the past and how he worked. We really did not see significant inflation in his first administration. In fact, before COVID, I believe it was a little bit under 2% annualized inflation. So we really didn't see that come to fruition, which many, many people said, oh, we're going to have this incredibly high inflation. And also going forward, I think we will continue to see some volatility, especially related to some potential supply chain issues for those, foreign manufactured goods. If you look at the auto industry, Ford and GM do require, and they buy a lot of their parts from foreign entities. So definitely, as Nick and Alex were commenting on, I think we are going to see this volatility continue, but I don't believe it's going to be to the long-term detriment. I think it's short-term pain, sure, but I think that this is for the greater good.
Yeah, I think during the first Trump administration, there weren't, most of the tariffs, I believe, were more focused on specific goods. This time around, we're talking about broader types of tariffs being issued, and the threat of tariffs this past week against Canada and Mexico, two of our biggest allies, certainly scared investors. I want to open this question up to everybody here on the roundtable. Are we concerned about consumer spending taking a dip if more tariffs if there are more tariffs out there, basically? Are we concerned about the impact that might have on the market? And feel free, anybody can chime in on this one.
I'll go. I'm not that concerned about the consumer, especially if these tariffs, don't get ridiculous. I think that Chinese goods are inexpensive to begin with. And so adding a 10% or even a 20% on select items, I don't think is going to deter the consumer from buying in. Now, I think the other thing that's at play here, which is a good thing, is the deregulation that President Trump is talking about, and reducing some of these regulations that are so demanding and expensive for these, especially these small and mid-sized companies. If we get in tandem where they can become more competitive, so if you have a tariff that is increasing the price of a foreign good, and you have someone here at home on the domestic side that can make that good pretty close to the same cost because it's not costing them so much in regulation and that sort of thing, they're going to be able to keep their margins reasonable and still be competitive in that space. And so what I like about it is I think it's going to bring a lot more of the consumer back home to the U.S.
So I know during the first administration, during those first Trump administration, we saw these targeted tariffs. And there was a case study about, I believe it was dishwashers, or was it laundry machines? The price went up, not just from what we were importing, but the cost of what was being made here in the U.S. also went up. It didn't seem like last time, because we saw where the issue this had in just a very small part of the market. But it didn't really lower prices. It didn't have a great impact on consumer spending either way. But a more broad tariff, as we're talking about here, that is a different creature. Is it not this time around? Feel free, anybody can chime in. But just something, I might have noticed last time with the tariffs, and the bigger concern this time with the broadness of them. With that in mind, let's take a bigger look at the market. There, we have a 10% tariff right now on goods coming in from China, and there could very well be tariffs later on this year. What type of investments do we like this year? Are there any particular sectors or stocks that we like in an environment where there are tariffs on the books right now, and there might be potentially more tariffs later on this year? I'll open this one up to the floor as well if anybody wants to chime in.
I think energy is definitely one that could benefit. I think there's others that are maybe more neutral versus underweight, but I think a big piece is still what we already have spoken about, which is where is production done? If it's like consumer goods or if it's consumer discretionary, where's the production versus where is it outsourced, or where does the product come from? I think that's going to have a big impact overall, because that's going to dictate, are costs going up because of the tariffs, or is it cheaper to do it domestically because of tariffs, doing it internationally before? As Faron said, and I do agree, I feel like there's going to be some companies and some production that's going to kind of come back to domestic based even more than maybe what it is now or what it has been in the past because of this.
Okay, so it could change sort of the dynamics of all that. Nick, you mentioned energy as a potential winner this year if there are tariffs, assuming the tariffs are not on energy goods or
Correct.
services.
Yeah, correct.
How should investors play that? Are there specific stocks you think investors should go after in the energy field? Are we talking more ETFs? What are you feeling?
I'm feeling more broad-based. I'm not really saying specific companies. I'm just saying energy as a whole, I feel could benefit from tariffs. Is again, as you said, Stephen, as long as they're not specifically tariffs against energy, I feel that's one thing that could benefit. Just and Alex said already, some of the gold and some of the pricing there has gone up. I feel like some of the metals could definitely also pose some advantages, but again, it depends where. You made a comment, that Mexico is one of the biggest silver exporters. Those are a lot of things to consider when we're talking about a lot of different countries and where things are produced and where things are shipped out of, when we're talking about additional costs that could drive price up.
No, you're absolutely right. You got to consider that. Alex, on that note, the metals, gold, I know you've been a big proponent of gold for some time, but do you like gold this year, especially if there are more tariffs?
Yeah, not just because of the tariffs. I want to go back to the consumer spending comment in a second, and I'll basically combine that with the tariffs. One thing to keep in mind, we went from about 3.1% unemployment rates to about 4.1%, and the Federal Reserve was alluding that the year-end unemployment might get to about 4.3%. Now, recently, President Trump provided a 8-month severance. If you look at the government, they're the 15th largest employer in the state. They have about 3 million employees, and the estimates was anywhere between 5 to 10% might take that severance package. Now, if you look at the employment market, specifically in the second half of last year, we saw government hiring more than the private sector. Now, you can argue and say, obviously, there was a lot of instability. The election was coming. But at the end of the day, when the Federal Reserve pivoted their policy from starting to lower the interest rates, Jerome Powell was very specific. He said, the risk of unemployment right now is higher than the risk of inflation. Now, why does this matter? We are very much of a consumer spending economy based. So if you look at the credit card debt, it's at all-time high, about 1.2 trillion. You look at the government debt, again, it's at all-time high. The reason why it's important to kind of take a step back and understand the implication of tariff, we already have an environment where not only the Federal Reserve is thinking about lowering interest rates, but also President Trump, when he went to the World Forum, he talked about other banks to lower the interest rates. Second, overall, we have central banks buying more gold, not because they like it. It all boils down, if you are going to give up investing in a yielding asset, such as U.S. Treasury bonds, there has to be good reason for you to invest in gold. And it boils down to really being in control and eliminating the counterparty risk. Mm-hmm. Take that environment and couple that where we are in terms of a GDP comparison to the total market cap. Many will argue that Warren Buffett's 208% might lead that we have some sort of a little bit more overvaluation. Now, if you add tariff on top of that, the market, gold market specifically, it's not usual for gold to have a 27% growth in a single year, especially when the S&P 500 was also double digit last year. So for the first month, we're already seeing gold up roughly about 9%, and that's not a very good thing. It's actually communicating that there are some underlying problems. So, part of us is thinking about that there is some hope. Deregulation is good, lowering taxes are good, cutting the unnecessary Fed is good, but we do have some sort of underlying problems, and we're going to see how the Federal Reserve and the government's policies are going to play out. So, gold continues to be a little bit more of a defensive position, specifically on the physical side, and we're seeing more and more on the institutional side. I believe the Western investor, if you look at the ETF GLD for a second, it's been having a net outflow, but yet the spot price of gold is increasing. So just to add to Nick's comment, I think, precious metals are positioned well this year as well.
Okay, so you like precious metals. I'm sure there's probably some risk with them this year, especially with gold reaching its all-time high, but we'll have to see about that. Faron, are there any stocks you like this year, in case, especially if there are more tariffs?
Yeah, I do. And it's kind of nice. We towards the end of last year, we actually started to see a broadening out in the market anyway. So it wasn't so razor focused on the Magnificent Seven and all of that. But with the tariff being kind of included in the equation now, I think things like utilities, regional banks, when you get some like the industrial defensive stocks, I think those are nice to add to a portfolio. I would probably look to do it more in an ETF format, just so you're grabbing a little bit of every piece of that and not betting on one or two specific stocks. But I think that's going to give a client, an investor, the opportunity to further diversify their portfolio and actually see some potentially better returns than what those sectors have provided in the last couple of years. And it does diversify you away from those very, the technology industry is so dependent on foreign manufacturing. And so I think those other sectors really help balance things out. And utilities is the bonus on top of that is just the high demand that's expected with the continuing growth of AI and the power that's required to do that. And of course, we can't forget about mining for crypto.
Oh, yes. Crypto prices, though, they're volatile as well right now. But
they
but
sure
you're
are.
right. There's different components of that. And so you brought up some interesting sectors that investors may want to be invested in this year, given where we are with the state with tariffs. On the flip side, are there particular stocks or particular sectors that investors may want to pump the brakes and avoid this year? I'll open this question up to anybody. Are there anything that comes to mind in terms of stocks or sectors investors may want to think twice about this year, given the state of the market and the state of tariffs?
Yeah, I mean, for me, I would say maybe healthcare, especially if we're talking about equipment that is coming in from a tariff country. I mean, that could be, so as an example, like I feel like companies like Stryker or Medtronic, I mean, they could be negatively impacted if production costs go up because of tariffs, and that could hit the bottom line. So I feel like investors want to be a little more cautious with them. I still feel, as we've said from the beginning, is that there's a big overreaction. There's a lot of uncertainty. I still feel the long-term outlook is still very positive. I just feel there's going to be some short-term pains, I'll call it, for investors.
Oh, yeah. This may not be the best year for healthcare, although last year was also not the best year for healthcare either. So we'll see if that continues. Alex, any particular areas you might want to suggest investors avoid this year?
Well, I mean, since I focus on the physical precious metals world, I can expand a little bit on the mining side. The mining sector in general has been performing very poorly. And it's not about you think that the spot price of gold and silver have increased last year, that their margins would have improved. But basically, the challenge is there's really no investor appetite for that level of risk. So, I know last part of the year, there was a hype in the nuclear power plants. You look at a company like Palantir, for example, post-election had a great run. I think moving forward, it's very much, rather looking at the industry, I think it's better to focus on a specific type of a company and go back to the fundamentals and see if you like the business model, see if they're well capitalized. When interest rate drop, if a company's kind of over leveraged, sometimes it gives it a short bump. But at the end of the day, are there some businesses that fundamentally make sense? Like I know Faron mentioned the banking sector. You look at, for example, Warren Buffett minimizing his position in B of A. There are opportunities within maybe a commercial side of the market that have more of a niche business. So just want to kind of give an overview related to metals.
Yeah, that's a good point you brought up there. Faron, close us out. What are there any sectors or stocks you think investors may want to avoid this year, given the state of tariffs?
Sure. I think, again, going back to like the multinational tech companies that rely so heavily on foreign manufacturing and the imports of chips, because there could definitely be some supply chain disruption. That kind of dovetails into that consumer discretionary sleeve that is reliant on inexpensively made goods abroad. Some of the big box stores where they're so reliant on importing from those foreign countries. And then even the automakers, you may just want to stand clear, because as a point of reference, I mean, I was helping my son's friend buy a new car a couple of weeks ago, and I was amazed when I looked at the sticker, because this was supposedly a U.S. made car, and they list how many, what percentage of the car is actually made in the U.S. versus other countries, and it was in the single digits in the U.S. So that was very telling. So I think, until this kind of blows over, those are some areas that I think I would stay away from.
Thank you again to Nick Bour, Alex Ebkarian, and Faron Daugs for sharing your insights on the markets. And thank you to everyone for listening to today's discussion. We'll be back next week for another episode of Early Bird. Have a great day.